All right, the recording has started. So, like I said, we are going to be starting with the format of the payee. How do you calculate the personal income tax of an employee? So the first thing is you have to calculate all the total income of the employee. Remember that we have total income as cash emoluments together with benefits in kind. Everything together is going to be gross emoluments, right? So I also have something called earned income on earned income, but we'll talk about that later. I think you
I can
see,
see your screen.
I can't hear you.
I can see your screen, ma.
Probably your network. I'm sharing my screen. Is there any other person that cannot see my screen? It's probably your network. Okay. So we have the total income from all sources, less non-taxable income, and income on which no further tax is payable. This is frank investment, that's dividend. So if you remove withholding tax from dividend, that is the only tax that you pay on dividend, withholding tax. That's the final tax. So if the person has dividend as part of their income, you add it, then you less it again. Then you less tax exempt item. Pension. If the person is paying pension, pension is tax exempt. So for pension, it's like a contributory scheme. Your employer will pay from their own pocket on your behalf, and you will also pay from your pocket. The one that you will pay is the one that is tax exempt here, which is 8% of your basic allowance, that is your basic salary, plus your housing allowance, plus your transport allowance. That's pension. The national housing fund, if you are doing this too, you remove it. Health insurance, life assurance, gratuity. All of these five are tax exempt items that you are going to remove before you get your gross income. After your gross income, you calculate your consolidated relief allowance. And it's the consolidated relief allowance is the higher of 200,000 or 1% of gross income. That is 200,000 in one side. Then you calculate 1% of this gross income that is here. You now check which one is higher. Is it the 200,000 or the 1% of the gross income? Whichever is higher, you add it to what? 20% of gross income. So when you remove your CRA, whatever you get is going to be your what? Chargeable income. Then you are going to apply the tax band. This is what we know as the tax band. The first 300,000 at 7%, next at 11%, next 500 till you get here, right? So if after you have deducted all of this from this chargeable income and the money still remain, the remaining balance will be at what? 24%. Then you add up all of these figures that are here, you add them up to get your tax liability. If you have paid any withholding tax on your earned income, you are going to less it. So the result or the remaining money will be your final tax liability payable. But the new tax reform affected the tax band, and also it affected computation of chargeable tax income. So under the new tax reform, there is no consolidated relief allowance anymore. It has been scrapped. Remember, we are sticking to this, so we are sticking to this old one for your diet. We are sticking to this old one. I just want to teach you guys this one because I don't want any surprise from my account. Okay, so under the new what's it called? The new Reform Act. Oh, I'm sorry, guys. Please, I'm really tired. There will be no consolidated relief allowance. This one that I bold in this one, all this 200 is not going to be there. It has been replaced by a rent relief allowance, that is rent relief allowance. And the rent relief allowance is the actual rent, the lower of the actual rent, or 500,000 naira. If your rent is 350 per year, you remove your rent as an allowance. If your rent is 1 million, your 1 million will be restricted to 500,000 naira, and 500,000 is what you are going to remove as the rent relief. So now the tax band has also changed. Before it was first 300, next 300, next 500, next 500, next 1,600,000, above 3.2 million. Now what we have is first 800,000, next 2.2 million, next 9 million, next 13 million, next 25 million, above 50 million. And the advantage of this new one is that anybody that is earning below minimum wage or minimum wage is exempted from tax. Is exempted from tax, right? So if your money is below minimum wage, you are exempted of tax. Oh, so but this tax band, we are not following this tax band for your diet, please. We are not following it for your diet. We are using the old dream. Yeah, I already talked about minimum tax conditions for taxation of income from employment. We are still on payee. Payee is pay as you earn, and payee is on employment or a contract of employment. Remember, can somebody tell me the difference between contract of employment and contract for employment? We spoke about this yesterday. If you want to say it, you can just unmute, or you raise up your hand, or you write it in the chat box. Guys, nobody is speaking. Oh.
So, contract of employment is like a contract that exists between the employer and employee. So it serves the employer as his boss, like salary earners. And so, while contract for employment is more like a short-time contract between the employer and employee, more like okay, plumbing work and electrical works.
Okay, you tried, but maybe saying no, no. All right. So you're correct in regards to contract of employment. But contract for employment has no employer-employee relationship. It does not create an employer-employee relationship. It's mainly a contract that you help the person to do a particular service, or to provide a particular service within a particular period of time. Okay. So this is why I asked the question. Payee is only for contracts of employment, because it is the employer that will be paying the tax on behalf of the employee. So there's like should I say, a burden on the employer to ensure that the payee is deducted and remitted as our due. Okay, so now let's talk about the condition. It provides that gain or profit from employment shall be deemed to be derived from Nigeria. So now, why do you say that your profit or your gain or your salary is derived from Nigeria? Number one, the duties of the employment are wholly or partly performed in Nigeria. So if you are doing part of the duties in Nigeria, then that particular part that occurred in Nigeria is income derived from Nigeria, or whether it's only or partly. So unless now there's a caveat that this particular only or partly derived from Nigeria does not apply in some circumstance. Number one, the duties are performed on behalf of an employer who is in a country other than Nigeria, and the remuneration of the employee is not borne by a fixed base of the employer in Nigeria. So you are working on behalf of somebody, and the person is not in Nigeria, and the money that they are paying you, as per you are helping them to work in Nigeria, is not even from any place in Nigeria. It's from that place which is not based in Nigeria. Maybe, for example, your employer is in Germany, and it is the Germany office that used to pay you your money. your salary. Maybe it's in, I don't know, the currency that they're spending in Germany. So maybe they pay you in that particular currency, and this from Germany bank, Germany office, in that case, then you cannot say that the income or the salary of that person is derived in Nigeria. No, it is not derived in Nigeria. Number two, the employee is not in Nigeria for a period of 183 days, inclusive of annual leave or temporary leave of absence. So the person is not in Nigeria for a period of 183 days or more in any 12-month period, commencing in a calendar year, ending either within the same year or the following year. So this 183 days, do you know who a resident is? It's part of the written aspect. And I remember telling you when we started this class, that when we started the whole class, all that that you guys should be reading written aspects by yourself. We are focusing on calculation. If we have time, we cannot focus on written. But for now, we want to ensure that we finish our calculations. So, guys, if you guys have been reading, can somebody define a resident for me? Who do we refer to as a resident of Nigeria? Oya, oya, oh. Okay, Uche, you can speak.
Someone that resides in Nigeria and do business in Nigeria, and someone that has stayed up to 183 days in Nigeria.
Okay, I think I have someone that stayed 103 days in Nigeria. Then you said someone that do business in Nigeria. Is that what you said?
Resides, yes.
Someone that do business in Nigeria. And what?
Resides in Nigeria.
Okay. So I would not say you are wrong. You are correct. In fact, thank you for even trying. Yesterday I was asking questions, nobody was even answering me. Today, I guess you guys you've rested well. Yesterday everybody was tired. So you are correct when you said that someone that has stayed in Nigeria for more than 183 days, that person is regarded as a resident of Nigeria. But when you see somebody that does business in Nigeria, I don't think that cuts it, because you can do business in Nigeria and you don't stay in Nigeria. I don't really get. But the income that you earn in Nigeria as a business owner that is attributable to a fixed base in Nigeria will be regarded as a Nigerian income. The person earning it does not necessarily have to be a resident. I don't know if you get me. But you are correct when it comes to the 183 days. That's why I even asked about the question. Well done, Uche. All right. So if the person is not a resident, the person is not using up to 183 days in Nigeria in a whole year, 183 days in a whole year in Nigeria, then your salary is not seen to be derived from Nigeria. Number three, the remuneration of the employee is liable to tax in another country under the provision of avoidance of double taxation treaty with other countries. So the remuneration that you are collecting, that is your salary, is liable to tax in another place. Number two that I'm talking about is profit or gain that are derived from Nigeria. We have talked about number one, and we have talked about the exemption. We have three exemptions to number one. We've spoken about them. Now, number two, the employer is in Nigeria or has a fixed base in Nigeria. So if your employer is in Nigeria and have a fixed base in Nigeria, then we assume that your salary or your profit is what is derived from Nigeria. The gains or profit from any employment exercised in Nigeria shall be deemed to be derived from Nigeria, whether the gains or profits from employment are received in Nigeria or not. So what we are saying here is that you got a salary from Nigeria, your work is being done in Nigeria, but when you want to receive payment, you might receive payment in Nigeria or in another country. The fact that you are doing your work in Nigeria makes it an income derivable in Nigeria, we derive from Nigeria then. So any period of leave of employee from employment and any period of his temporary absence on duty from Nigeria. I'm not really sure what they are trying to say here, honestly. Like, what are they saying? Period of leave. I'm not really certain of what they are saying here. Because period of leave related to income. I'm not sure, please. The gains of an individual from any employment as a seafarer. I think those people that used to be on sea, other than Navy or Nigerian Port PLC. Like if you are in Navy or Nigerian Port PLC, this does not concern you. But if you are not in these two, then your income shall be deemed to derive from Nigeria only when that individual is serving under article that he has signed in Nigeria or performing standby duty on a ship preparing to sign his article in Nigeria. Maybe there's something called article under all this seafaring stuff, right? So if the article is under Nigeria, whatever amount of money that you get at that particular time that your article belongs to Nigeria is going to be derived to be earned in Nigeria, therefore taxable in Nigeria. So with respect to income from an employment that is derived or deemed to be derived from Nigeria, assessable income of an individual is the amount of income of the year of assessment. So your assessable income is the amount of income that you earn for that particular year. For this purpose, income from an employment shall be deemed to arise from day to day, except to the extent that it is derived from bonus, commission, allowance payable on one occasion or at intervals exceeding 1 month. And to that extent, it shall be deemed to be income of the day on which it is paid, or if it is paid after cessation of employment or the last of employment. All these jargons that they are saying, what they are saying is that, we know your salary. Your salary is quite explicit. You earn this amount per month. And according to the tax authority, this your money that you earn per month, it accrues to you every day. Like daily, if you go to work on Monday, there's an amount, part of your salary, that already belongs to you. That's how it works. But this does not apply to bonus or commission, because it's not every day that you get bonus. It's not every day that you get commission. It's not every day that you're going to get allowance. When you now recognize that this person has earned a bonus, this person has earned an allowance or a commission, number one, the day that they pay that bonus to you, the day that they pay the commission or allowance to you, or if, for example, you left the place already, then they not paid you a bonus, then it's going to be assumed that they paid you the bonus on the last day that you worked in that particular place. I hope we are good. Now, income tax chargeable on an employee by an assessment, whether or not the assessment has been made, is recoverable from any emolument paid or from any payment made on account of the emolument by the employer to the employee. So now we are talking about payee, right? And payee is tax on the employee, like on the person that is working for somebody. Now, if your employer has calculated your payee, you don't expect the employer to pay for you. It's going to be from your own money, from your own salary. So they remove it from your emolument. So now the tax authority primary goal is to ensure that the total tax deducted from your paycheck over the course of the year matches exactly what you owe based on your total earnings. So now, it is your employer that will calculate your payee for you. Some people don't even know that they are paying payee, funniest thing. Some people don't know. And some companies cannot calculate this thing by themselves. That is the work of the tax consultants. They reach out to an accounting firm that would help them to calculate their payee by themselves. They are paying for them. So now when they calculate the payee, it must be the amount that you have calculated for your employee that you remove from their money. Don't calculate 50,000 and remove 70,000. It's going to be so unfair. Do you get? So when calculating your monthly deduction, tax authority is not limited to your salary. They factor in money that you earn from other sources to ensure your total tax contribution is sufficient. Now, some people, they work 9 to 5, like myself now. And apart from 9 to 5, they also have other work that they do. Let's take, for example, government workers. They usually have shops. Apart from government work, they will have shops somewhere, maybe in their house, in the market. So, if you now want to calculate their tax, you cannot consider only the money that they earn from their 9 to 5. You have to consider the profits that they make in the shop that they have in the market. Let me take myself as an example. I have a 9 to 5 job. So my boss will, of course, calculate tax on my own salary, like the one he knows about. But personally, I know that I have another job apart from my 9 to 5. I have a business that I run, all of which are taxable. Do you get? So my tax will not be only on my salary. It's up to me to make a self-assessment of all that sort of income that I have and calculate my tax on it. I can inform my employer so that he or she will add it to what I have. Or I will just do my self-assessment and calculate my pay for myself. Do you get? So any tax already deducted from your salary acts as a prepayment. So if my boss already paid payee on my behalf, my boss have paid my own tax for my salary. When I now calculate my assessment later by myself, and I say that, oh, this is my total assessment, my total tax, I will remove the money that my boss have already paid for me in that tax before paying the remaining balance. Let's proceed. If you receive a formal tax assessment later, deductions already made are subtracted from that bill so that you are not taxed twice on the same income. So the reason why I'll be removing my payee from my own self-assessment is because somebody have paid on my behalf before. I have to remove what they pay before what pay the remaining balance. Failure by the employer to make the deduction or properly account for the tax deducted will result in the amount, that is the amount that you are supposed to deduct, or the one that you deduct and you did not go and pay, together with a penalty of 10% per annum, 10% of the amount that you refuse to pay, plus interest at the prevailing rates or at the prevailing monetary policy rate of the CBN. Let me give you a scenario. You are supposed to remove 50,000 from your employee's money and pay to the tax authority. You did not remove it, or you remove it and did not pay to the government. Now, you are going to pay penalty, and the penalty is that of 50,000 plus 10% of 50,000 plus interest. Like if you know the monetary, let's assume the monetary rate is 25%. 25% of 50,000. If you add the three together, that is now the amount you will pay instead of just 50,000. Okay. Please, I hope we're not confused. Before we move on, is there any question? No question. Okay. Determination of residence. I don't even know that residence is here. An individual is regarded as a resident in Nigeria in an assessment year if he, number one, is domiciled in Nigeria. If you are domicile means you are living in Nigeria from January to December. If you know what, you're not going anywhere. Some people in this class have not gone outside Nigeria since they were born. You are the original residents of Nigeria. So if you are domiciled in Nigeria, you live in Nigeria, then you are a resident of Nigeria. Number two, you sojourn in Nigeria for a period amounting to 183 days or more in a 12 calendar month. So now, you are not entirely domiciled in Nigeria, but you have stayed in Nigeria for 183 days or more. That is, it can be 200 days, it can be 250 days in a particular year. Now, when we talk about a year, that is a 12-month period, it could be January to December, it could be June to July, it could be March to April. I don't know if it could be April to March. It's not compulsory January to December year. As long as if you count 12 months, you have used more than 183 days, then you are regarded as as a resident of Nigeria. And the last one, you serve as a diplomat or diplomatic agent of Nigeria in a country other than Nigeria. It does not mean you are no longer a resident. You are still a resident of what? Of Nigeria. Now, who is a non-resident? It's just like the opposite of what we read. Somebody that does not live in Nigeria. You are not a domicile in Nigeria. You stay in Nigeria for less than 183 days in a 12 calendar period. But you derive income from Nigeria. So that's what I was saying, Uche. So even when you carry on business in Nigeria, it does not make you a resident, right? But your income that you derive from Nigeria is taxable. You get. A non-resident becomes liable to tax in Nigeria from the day it commences trade. You commence your trade or business or vocation in Nigeria. In the case of employment income, is liable to tax in Nigeria when he becomes a resident. Please let me explain this case very well so you guys will not get confused. You are a non-resident, that is, you're not a resident of Nigeria. If you are a business person, if you are a business person, the moment you start business in Nigeria, you start selling something in Nigeria, from that day onward, they can start taxing the profits that you make on that business. That's for business part. But for employment now, you are a non-resident, but you have an employment income, like you have an employment in Nigeria. You are not going to be taxed until you become a resident of Nigeria, because you are a resident of another country, and that country too will collect tax on your income. Do you get? If Nigeria now say that they also collect tax, that will be paying two tax on the same income. So that's why they now say that in Nigeria, if you only get tax until you become a resident of Nigeria. So now the difference between residence and nationality. Residence is not the same thing as nationality. Nigerian tax law attach importance to residence and not nationality. No, somebody can have more than one national. You can be a Nigerian and also an Algerian or American. I don't know. Do you get? But what we as tax authority, I'm not a tax authority, but at this moment I'll consider myself as one. What we are considered about is residence and not nationality. Are you a resident of Nigeria? Therefore, whether you are a citizen of Nigeria or another country, the same standard apply to you as far as you are a resident in Nigeria. It's residency that we are after. The same condition will apply to an individual who is not resident in Nigeria, whether he's a Nigerian or a foreign national. Now, place of residence. Let's talk about the place of residence. This is a place that is in regard to an individual, somebody. It's a place available for his domestic use in Nigeria on a relevant day and does not include hotel, rest house, or other place at which he is temporarily lodging, unless no more permanent place is available for his use on that day. So your place of residence is where you use, like your domestic place, ibi tó máa ń sùn sí, ibi tó máa ń dúró sí, where you habitually stay in Nigeria on any relevant day. And of course, you are not counting hotel. You are not counting all this lodging, rest house, or all this temporary place that people just, all this guest house and here is not a place of residence. Right? Now we have something called a principal place of residence. A principal place of residence is applicable to somebody that has more than one place of residence. Like, some people have like 3 houses. Let's say, for example, Nike. Nike is just a random name. Nike has a house of her own. She has finished her BSc. She got a job and she just decided to rent an apartment that is close to her workplace. So Nike has a house, but Nike can also sleep in her parents' house because her parents, of course, did not send her out of the house. She's the one that voluntarily decided to what? To go and take an apartment. She's one that voluntarily decided to go and take an apartment. So Nike can stay in her house, Nike can stay in her parents' house, but lucky for Nike also have grandparents. And her grandparents be like, Nike, anytime you wish to come, you can come. Oh. Do you get? So now Nike has 3 places that she can stay. She can stay for as long as she wants. Please give me a second, guys. Sorry for the distraction, guys. Let's go back to what we are doing. Okay, so I was explaining principal place of residence ahead. Nike, I was talking about Nike. We have established the fact that Nike has 3 places that she can sleep, she can stay, right? And at any time, she's welcome at any time. Now, for Nike, where would we say is our place of residence? Because you already said that place of residence is any place that is available for your domestic use. Nike has 3 places that is available for our domestic use. So where exactly is our place of residence? That's what we are trying to determine using the word principal place of residence. Now let's go ahead. In case of any individual, number one, individual with no source of income other than pensions in Nigeria, that place or those places in which he usually resides. Now, if you are an individual that you maybe an aged person, agbalagba, and the only source of income that you have is pension, so your principal place of residence is where you usually reside. You know, you can have more than one place, but where do you usually stay? That will be your principal place of residence. Number two, you have a source of earned income other than pension. So you are collecting pension, but you also have another income. Maybe you have a business or you have a side hustle, and you have more than one place of residence. Your principal place of residence is the place that is nearest to your usual place of work. So let's take Nike as an example now. Let's assume Nike also takes pension, right? Or maybe not, sure. Now, if Nike's place is the place that is nearest to but Akiniko, wá ibi tó kọ tírì sí ni o, ibi tó kọ tírì sí má jẹ́ kún lẹ́múlẹ́mú ibi tí tírì wà yẹn. Sorry for that. The principal place for Nike now is the place that is near to our place of work. If our own personal place is the nearest to our place of work, then that will be our principal place of residence. If our parents' place is the nearest place, then our parents' place will be the principal place of residence. So now number 3, you have other sources of you have sources or source of an earned income in Nigeria. What income do we regard to as unearned income? Can anybody tell me? What income do we regard to as unearned income in Nigeria?
More like income that he or she didn't work for, like gift and
They're like benefit in kinds.
Okay. So any other opinion? All right. So guys, you tried, but you did not get it right. Benefit in kind is an earned income. You know, earned income is divided into 2. We have cash emolument and benefit in kind. Cash emolument is your salary, things that come in cash. Salary, bonus, commissions, those things are cash emolument. But benefit in kind, on the other hand, is not in cash, but it comes in forms of other stuff like car, official apartment, official driver, and so on and so forth. All of those are earned income. When you talk about unearned income, these are income that I can't say that you did not earn them because it's not like your money is working for you, but you're not exerting energy. A very good example is dividend, interest, royalty. These are things that you're not stressing yourself for. You only put your money someplace. You allow somebody to use your assets. You borrow somebody money, and the person is paying you money. You buy shares in a company. The company is paying you money for buying shares in their what? In their firm. Those are unearned income. Those are unearned income. So if you have unearned income, then your principal place of residence is the place that you usually reside. The place that you usually reside. Now, if you work in an office or operational site of a company, the place of which the branch office or the operational site is situated. Now, you work in an office, or let's say for a construction company, you have to go to a site for a particular period of time. Your principal place of residence is going to be the particular area where your branch office is. Usually do not go far from your office space. So that's it about principal place of residence. Residents of different categories of individuals. Now, we have different categories of individuals. Liability to income tax is often determined according to whether a person receiving income is resident in a state for a particular year of assessment. Because this tax will be collected by somebody, right? Which government will collect your tax? That is the question here. Is it your state government that will collect it, or Osun state government that will collect it, or Ogun state government that will collect your tax? You need to determine your residence so that you can know who will collect your tax. A taxpayer is therefore liable to the tax authority of the territory in which he is deemed to be resident for a year of assessment. So that's what we are saying. So you are liable to pay tax to the what? To the tax authority of it. So if you have decided that your residency is what, or your state, then you pay tax to what? You pay tax to the tax authority of your state. You pay tax to the tax authority of your state. But first, you have to determine where your residency lies. Your residency will determine who you are paying your tax to. Now, the following rules guide the determination of residence. I think this is something it's similar to what we did before, but the rules are different from the above. An individual, whether you are in employment or your only source of income is an unearned income, what we're saying is that you have an income, right? Is deemed to be resident for a year of assessment in the territory in which he has a place available for his domestic use on the 1st of January of year of assessment. So now, on the 1st of January, where were you? Where were you? And of course, we're not talking about hotel, we're not talking about restroom or guest house. Like the place that you live as at the 1st of January is going to be your residency if you have employment or other unearned income. Now, an executor is deemed to be resident in the territory in which the deceased individual was last seen to be resident, was last deemed to be resident, or would have been resident if the law had been enforced prior to the date of his death. So now I think executor is somebody that, like, should I say, when someone die and the person leave a will, the person that will help him to execute his will is the executor. So now the executor will be they will be taxed. We're still going to get there actually. They will be taxed on those estates that the person leave behind, and the executor will be in charge of everything. Now, who will the executor pay tax to? That's why we need to determine the residence of the executor. So now the residence is now going to be the territory that the person that died was resident before he died. Is the person resident in Oyo State, then the executor of resident in Oyo State. Was the person resident in Kebbi State, then the executor will be seen as a resident of what? Of Kebbi State. Now let's talk about a trustee of a trust. A trustee of a trust or settlement will be resident where all the income of the trustee or trust for a year of assessment arise. A trust. So the trustee is the person that is in charge of like a particular trust. When we are still going to get to all of these things one by one, because we'll talk about how to calculate income tax for every one of them. Now, this person will pay tax on the trust or on the settlement. You get. But who is he paying tax to? Where is the income of the trust coming from? Like where? The place that the income is coming from is the place that the tax will be paid to. That is, that place will become his residence. But in a case where the income arises in more than one place, income is coming from Oyo, it's coming from Osun State, it's coming from Lagos State, it's coming from Abuja, then you know that there will be a fight on who will collect income. So in that case, NRS or the FIRS will be the tax authority. That is, the person will no longer pay to the state, but will pay to the federal government. Partners in partnership are deemed to be residents where the principal office or the place of partnership is situated on the first day of the year or first established during the year. So 1st of January, where is your partnership office? The place that your partnership office is situated is the place that we are going to conclude to be residents of the partnership. Remember that, okay, I don't think I've said it before. For a partnership business, we don't tax partnership business. Unlike company income tax, when we have a company, we tax the company because we see that the company is a different individual. The company is a separate ledger entity from its owners. But for partnership does not follow the separate legal entity rule except for a limited liability partnership. Now, we are not talking about a limited liability partnership here. We are talking about the normal partnership. So for a normal partnership, we don't tax the partnership business itself. We calculate the profits that the business has made, share it to the partners, and go and tax that profit in the hand of the partners. Now, for us to not tax this partner, we need to know their residence. Now, for a partnership, the residence will be what? The territory in which the principal office of the partnership business is on the 1st of January. So now let's now assume that the partnership business was not in existence on the 1st of January. And they established the partnership, maybe, let's say, June or July. Then that June or July that they established the partnership, the territory in which the principal office is becomes the residence of the partners. Now, a village or indigenous community is deemed to be residents in the territory in which the community is found. This one is clear. An itinerant worker. I think we've spoken about an itinerant worker, somebody that spends at least 20 or 30 days, 20 days in a particular place, 20 days in 3 months in a particular place. As long as he has spent 20 days in 3 months, he's able to pay tax in that particular place. So an itinerant worker is somebody that does not stay in one place. He works all over the place. He can be in Lagos today, Abuja tomorrow, Sokoto next tomorrow, because he's not stable in one place. It's hard to know that who is this guy going to pay tax to in a particular year of assessment, since he's just hopping around, right? So now, then I think we spoke about it yesterday that as long as he has spent 20 days in 3 months in a particular state, he's liable to pay tax to that particular state for that particular period. So now, his residence where he is found in a year of assessment, ibi tó bá ti rí náà ló ti máa san owó in that particular year of assessment. So for an individual, not being a person accessible by FIRS. So if you read your written aspects, you would have read the places where they talked about taxes payable to the federal government, to the state government, and to local governments. And you would know that all of the people that we have been talking about since are people that are liable to pay tax to the state government and not the federal government. And this is what they are saying here. An individual that is not supposed to be paying tax to the FIRS. Guys, let me ask you a question once more. Who are individuals that are to pay tax to FIRS? Normally, individuals are to pay tax to the states, that is the state's internal revenue service. But there are some individuals that their own tax authority is FIRS. Kindly list those individuals in the chat box. Wilfred, your hand is up.
Yes, those individuals like individuals who are in the military, like soldiers and the
So soldiers
military,
and who?
yes, police and people who are let me say foreign these things that are to pay tax to FIS.
Ambassadors.
Ambassadors, yes.
Yeah, thank you very much. It shows that you are able. Bukola Police Force, you are correct. You are correct. So you guys should read, though. See that as we are talking about one thing, we are moving to the topics are going inside each other. It will be difficult for you to even understand what we are saying if you have not been reading, and your exam is also fast approaching. Okay, let's continue. It's correct. Thank you, Wilfred. Okay, so now an individual not being a person accessible by FIR, that is, that person is not somebody, is not a military person, is not a foreign ambassador, and is not a police who holds a foreign employment on the 1st of January in a year of assessment, or first becomes liable to income tax in Nigeria for that year by reason of entering employment during that year, shall be deemed to be resident for that year in the territory in which the principal office of his employer is situated on that day, or on the day his foreign employment commences, as the case may be. So now, somebody got a foreign employment. That is, you no, we already defined what a foreign employment is. That is, your duties are not performed in Nigeria. Your duties are performed outside Nigeria, right? Now, on the 1st of January, you hold a foreign employment, right? You hold a foreign employment. Then what will be your residency? Like I how can I say it? What will be your residency? Your residency will be the territory in which the principal office of your employer is situated, or day on which his foreign employment commences, as the case may be. This is the day that they wrote there. I honestly don't understand what they mean by the day, but I understand the principal office, which means that the place where your principal office is the tax authority in that territory is the one liable to his tax, right? So an individual whose only source of earned income arising in Nigeria on the 1st day of January in a year of assessment is pension, or you add a place or principal place on that day, shall or who add a place or principal place on that day, shall be deemed to be resident for that year in the territory in which that place or principal place of residence was situated on that day. You just like to disturb somebody with stupid English. I don't know if they will die if they speak straight English. What they are saying is simple. Your only source of income is pension, and you have a place or a principal place of residence. That's on the 1st of January that you usually stay. So your principal place of residence or your territory in which you pay tax will be that same place that you stay, that principal place of residence that you stay. And that's just it. So now income. Here, I know we're supposed to have talked about any income or any income. Income now. For the purpose of personal income tax and place of residence, income is classified into earned income and unearned income. Now, earned income in relation to an individual is any income derived by him from a trade, business, profession, vocation, or employment carried on or exercised by him, and a pension derived by him in respect of previous employment. It includes profits, salaries, wages, commission, bonuses, etc., etc. Somebody's hand is up. Wilfred, Wilfred, you can speak. You can unmute and speak.
Yes, sorry, ma. My question is that I'm confused a bit.
I cannot
I
hear
want.
you.
Yes, I'm saying that. Can you hear me now? Hello.
Yeah, I can hear you now.
Okay. What I'm saying is that when you are talking about the residents and the first thing that I mentioned that the first day of January, that if someone was saying in the first day of January in a particular place, that will determine, like that is determining the place of or the principal place of residence for a particular individual. So now my question is that what if this person, I'm staying in Lagos and I have my business in Lagos, which is where I'm earning my money, and I have family, maybe I have like two wives. One is staying in Kaduna, the other one in Enugu. So, but where in Enugu, that is my place where my parents, that is my village. So, I during Christmas also I come for visit, I come for Christmas celebration in my village, and I extended till the first day of January met me in Enugu, which I only come to Enugu for that period, and my money, I earn my money from Lagos State, and my wife that is staying in Kaduna, I visit her maybe weekend. Every weekend, I go there to visit her. So are they now telling me that with this rule now, is it Enugu State that will now collect my tax, or is it the Lagos State government?
Thank you very much, Wilfred. Your question, it shows that you have been following the class, right? So your question is very valid, but it says that residence is the place that any individual has for his domestic use, and it excludes what hotel, lodgings, or any place of temporary use. Your grandma place in, I think, Enugu that you mentioned is not a permanent domestic use for you. Even your wife's place that you go every weekend is not a permanent domestic place for you. And the reason why we listed a lot of categories for determining your place of residence is because they know that everybody has a different situation. In your own case now, you have more than one place of residence. Your place in Lagos, your wife's place in Kaduna, your parents' place in Enugu. Now, because you have more than one place, the 1st of January criteria would not apply to you, number one, even though those two places are not, like, they're not permanent places of residence. But apart from that point, you now need to know which of the three places is your principal place of residence. You are somebody that earn employment income because you work in Lagos, right? So the rule says that for someone that earns employment income, or maybe you add pension to it or not, as long as you earn employment income, your place of residence is going to be the place that is closest to your place of work. It was the example of Nike that I was making. So if you go by that criteria, Lagos remains your place of residence, your principal place of residence. You use the word principal for somebody that has more than one place of residence. So your principal place of residence is still going to be Lagos.
Okay, thank you.
All right. I hope you are good now.
Yeah, I'm good.
So you need to read those different criteria. We have different criteria for somebody that is earning employment income, like your example. For others that they don't have employment income but they have pension, some no we read everything now for trust, for partners, for executors. So you need to follow the rule to know where exactly do they call their place of residence. So thank you for the question, Richard. Let's continue. So now we already talked about end income. So for end income now, place of residence, an individual that has a source of end income in Nigeria for a year of assessment other than employment or pension shall be deemed for that year in the territory in which it has a place or principal place of residence on the 1st day of January. If source of income is first acquired by the individual during the year of assessment and he has no place of residence on the 1st day of that year, he shall be deemed to be resident for that year in the territory where he first establishes a place of residence during that year. All these are English. Let me break it down. So what they are saying is that you have an end income. You have an end income, like source of end income for a year. So your place of residence is wherever you are. That is the territory where you have a principal place of residence or a residence. Remember that a principal place is used when the person has more than one residence. Then you pick one of those ones according to the law. That place becomes your principal place. So that principal place on the 1st day of the year. So they now said that what if the person does not even have a principal place of residence or a place of residence as on the 1st day of the year? Then they now said that it becomes the territory where it first establishes a place of residence. Okay. So the moment you find a place to stay, that place, the tax authority in that place becomes like your residency tax authority, like the territory becomes your residence. Okay, so that's for end income. On end income now, their income derived from other sources other than employment, business, or reward for services rendered. And it includes investment income such as rental income, dividend, royalty, earnings from trademark, patents, etc. Others are gifts, inheritance, and bequeathers. Place of residence for people that have unearned income. Number one, individual with no source of earned income in Nigeria for a year of assessment, or has one or more sources of unearned income in Nigeria for that year, shall be deemed to be resident in the territory in which he has a principal place of residence on the 1st of January of that year. Now, this one is 1st of January. If all the unearned income of the individual for that year arise in one territory and he has no place of residence on that day, he shall be deemed to be resident for that year, in that where the income arises. So if that person does not have a house, I mean a place of residence, which I think is quite impossible, for the 1st of January, then his place of residence become the place where all his money is coming from. And that is only when the money is coming from one place only. Maybe all these investment is Oyo State, all the decided to Lagos State. So Oyo State, Lagos State becomes what place of residence. But if they arise from more than one territory, one is coming from Lagos, one is coming from Abuja, others are coming from, let's say, in fact, it could be from abroad, and he also has no place of residence on the 1st of January, there is deemed to be resident for that year in any part of the territory. Like you can choose any place, any part of the territory that any of those income arises. Corporation soul. A corporation soul or body of individuals other than a family shall be deemed to be residents for a year of assessment in the territory in which its principal office in Nigeria is situated on the 1st day of January of the year. If it has no office in Nigeria on that day, in a territory in which any part or the whole of its income liable to tax in Nigeria arises for that year. Okay, so now this corporation soul is for what? Our sole proprietor, like those people that they are not a company, is a business but not a company. Remember that company is separate legal entity. These people has no separate legal entity. Do you get? So now they're not saying that what is the place of residence for a corporation soul? What will be their place of residence? It's going to be the place where the office is located, their principal office. If it doesn't Shishe it's going to be their place of residence. Let's now assume that the business has no principal office. Let's say it's a virtual business. Then it's going to be the territory in which they earn their income. The income that is liable to tax, they shall earn the income. So the place where they earn the income and the income is coming in becomes the principal place of residence. Now, resolving disputes over residence rule application. Like I said, this residence is to cause wahala among states. Some states will be saying, I'm the one that is liable to this person's tax. I'm the one that is supposed to have collected this person's tax. Why did you collect tax? Let's say, for example, Lagos State and Ogun State can be fighting and saying that this particular place is in this particular place, the residency fall in our place, but Ogun State already collected the tax. Give us our tax. We are the one that will collect the tax. But there are rules to be followed. It's just that there's no how they will still be disputes, right? So now, how do you resolve disputes when it comes to residency? Number one, where the territory of the residence of an individual for a year of assessment may be determined under one or more of these circumstances. It shall be determined by the first determined circumstance applicable. So what we are saying is that we have given a lot of illustrations, a lot of examples on how to know the residency of an individual. Now the question now arises that what if one person fall under more than one of these categories? What if one person earns the employment income and is also an executor? What if one person is a partner and is also, let's say, he also gets pension? How do you say it? There are different rules for this set of people. So they now say that what you do is to apply the first applicable rule. Which one is the first applicable rule? That's what you should follow. Number two, if because of the above, determination of residence, that is because of number one that we discussed, determination of residence of an individual for a year of assessment failed to be revised by a tax authority other than that of the authority in which the individual is finally determined to be resident for the year. It shall discharge any assessment made by it on the income for that year. So now, let me make a realistic example for you to understand this number 2. Lagos is saying that they are the one that is liable, they are the one that will collect the tax of, let's say, welfare. You know, welfare works in Lagos, and welfare is also, he also used to go to his wife in Kaduna. Kaduna is telling him that you stay here, your family, you are here. They are making claim to welfare tax and saying that they are supposed to collect tax on welfare. Lagos is also saying that they own this tax. So Kaduna feel like, okay, they want to be smart, and they quickly made a tax assessment on Wilfred and asked Wilfred to pay his tax. But upon due diligence of, let's say, Wilfred tax consultant or Wilfred employee, they got to know that they are supposed to pay tax to Lagos and not Kaduna. Then Kaduna has no right to enforce Wilfred to pay tax. Kaduna's assessment is going to become what? Should I say, it's going to be discharged. They're going to like overlook Kaduna's assessment, and Wilfred will not pay any tax to Kaduna. So number 3, where a dispute arises between 2 or more tax authorities, or between tax authority and an individual with respect to residence of an individual for a year of assessment, that is, there's a conflict between either 2 tax authority or tax authority and an individual, what do we do? Number 1, the aggrieved party shall set out all the ground on which it relies to refute the determination. So whether it's individual that is fighting, you put together, should I say, evidence. Why are you fighting these people? They gave me a wrong assessment. I am not liable to tax in their territory. Like, why? You put together all this ground together. Then you take those ground and you take it to the joint tax board. That's BISH. You take them to the joint tax board. Secretary to JTB they will give the notice of this ground that you have talked about, or the fact that you have given them. They will take it to the relevant tax authority, and any individual that is affected by these things that you have brought to them will take it, right? So by determination of the relevant tax authority, they will give those people, whether the tax authority or the individual affected, 40 days to reply to them. No, you have given them a reason why you have rejected what these people have done to you. They will now reach out to those people and say, let's say Pfizer has come to us and has complained that you have given he or she a wrong assessment. What have you got to say? 40 days, within 40 days, they must reply. Then you can, the secretary to the joint tax board can also ask for information. Give us any information. Like they also make their finding. So after 40 days, which is, I'm reading E now. After 40 days or before 40 days, any of the 2. Any of the 2. After or before, after. If 40 days have expired, it's also after now. Or the party that they gave 40 days to, he gave them a reply. Is it that the time expired, or the person replied before the time expired? Let me put it that way. So if whichever come first, maybe it's the time that expired first, or the person that they gave the letter to responded first. JTB will determine the residence of the individual that came to them. So then the board, JTB, would now give a notice of determination to that individual and the tax authority that, okay, we have helped you to determine the what? We have helped you to determine the territory or residence of the person. Now, the tax authority that has referred the objection to JTB shall not determine the objection unless the objection is withdrawn by it in writing. This thing is still plenty. So you guys are not going to read it by yourself, right? Because we don't have time. This one is just, if you want to settle this dispute, I think I've explained it to let me just try to like summarize it so that it's going to be easy for you. We have talked about where the JTB will determine residents by themselves, and they will tell both parties that this is what they have determined. Now, let's assume that one of the parties, let's say the tax authority that they gave the report to, said that this thing is not possible. But remember that it was somebody that brought the matter to the joint tax board. That person cannot object to. It's the opposite party that can object to the assessment of your matter. Say, I know we don't agree. What you have, that your residency that you have given us, or that your judgment, we don't agree to it. So that person can now take because joint tax board have done their own part. You can now go to high court. You go to high court to go and object, right? And it has to be the high court in the territory of the tax authority that have made their assessment, or the person that is, or that authority that is objecting. Now, if high court have not done its own, and you still feel like, I don't agree with this thing, you can go to court of appeal, you can go to Supreme Court, but it has to be in the territory of the residence of that individual. You get, that will be the territory of that individual. So now, if after you've gone to the courts of appeal and you've gone to the Supreme Court, and they end up seeing that that particular individual is not supposed to pay tax to that particular tax authority, the assessment that the tax authority did for that individual is going to be dissolved, like it's going to be discharged, it's going to be disallowed, something like that. And if that person have already paid tax before, that tax is going to be set off against any tax that the person owe before, like you're not paying any other tax to that particular person. Or if you have not paid, you pay to the government. And if the two cannot occur, the kukuma pay the money back to the individual. Do you get? So now, an employer shall within 6 months of commencing business deduct tax from his emolument of his employee and remit to the relevant tax authority within 6 months. That's for new business. Failure to do so will lead to payment of 25,000 naira in addition to the arrears of tax due. Where the employee works under the supervision of a person, let's say a manager, the person is not his employer, but he works under the manager. That manager shall furnish the returns of the employee's emolument and deduct the tax and remit it to the relevant tax authority. Now, record of deduction. Employer cannot just remove money from your salary and not have record for it. So you either record this deduction, the tax, in a tax deduction card or in any other form that is authorized by the tax authority, as long as it includes this following information. Number one, which month did you remove money for? How much did you remove? And like, how much is the emolument? Contribution of the employee to the pension fund, net emolument as at the particular date, how much is the free emolument, how much is taxable emolument, how much is the tax, then how much did you deduct from the person. Okay, so where an employee in respect of whom a tax deduction card has been issued cease to be in employment, that is, you have issued tax deduction card in, let's say, Presco PLC, and the person now is no longer working in Presco. The person has left Presco. Now, the employer shall send to the relevant tax authority a certificate in the prescribed form containing the name of the employee, number used to identify the employer, address, date, blah, blah, blah. The person will send it to the tax authority. Certificate of deduction of tax. Employer shall make on a prescribed form 2 copies of certificate and deliver to the employee on the date on which the employment ceases. So you also give the employee the certificate. You give the employee certificate. No, that means that the person has been paying payee. No, it's not the employee that is paying payee all this, right? It's the employer that is paying on behalf of the employee. And because of that, the employee will not know whether the employer is fully paying or not. It is that certificate that will now serve as evidence that the employer has been paying payee on behalf of this person. On the commencement of another employment, the employee will not give that 2 certificates to the new employer. I think there are other things regarding this thing that I didn't have in this because it was too much. It will only make this thing long. It's already 28 pages. It will really make it worse. So I skipped it. So the employer will also take the particular stuff to the tax authority and so on and so forth. You can read it up in the pack, sha. So now, death of the employee. On the death of an employee on whom a deduction card has been issued, the employer shall send the collector of taxes the certificates and insert the name and address of the representative of the employee that have died. Any emolument paid by the employer to the employee's next of kin in making such payments deduct tax. So, maybe the person has salary that they will pay. Upon the fact that the person is dead, they will pay it to the next of kin. So before you pay payment to the next of kin, you remove government tax. Do you get? And you have to inform the government that the person has died. You go and return the person's tax deduction card. Remittance of tax deducted. I told you that there's a difference between filing and remittance of tax. Filing is you submitting the documents that shows your tax payable, right? Like for these people now, maybe tax deduction card, something like that. It shows in practice, like you now use tax promas for FIRS. For SIRS too, all of these states have their own website. Your state has their website, Ogun has website, Lagos has website, and that's where we file taxes, right? Usually in Excel form, they will have a what's it called, format. The format will be on their site, so you don't say that you don't have access to format. It's always on their site. You can download it. You put all the information in the format, then you now submit the format that has been filled with information of your client. That is called filing. When you submit that particular information, remittance is where you pay the money. You pay it to the tax authority. Before, people go to the bank, but now everything is done online. Except if you are scared, that come on, hard, because I'm telling you, network can be very funny. The money should hang last time before you can collect the money back. You sweat. But in nowadays, we just use remitter. You use remitter and you pay online straight. So now, remittance of payee. You are supposed to remit your payee within 10 days of the end of every month. So if January should end, within 10 days of the end of January, that is February 1 to February 10, you ought to have remit the payee for what? January. An employer shall pay to the nearest tax office or to any bank all tax deducted under this regulation. The tax officer shall give employer a receipt on the prescribed form for the total amount paid. So they will when you pay online, I said it is that in reality, you pay online. There's a receipt that they issue, and the receipt will always be available on your portal. So it will always be available on your portal. So even if, let's say, you download it before, you cannot find it again, you can easily go and download it again. But some people go to the bank and go and pay. All of these things, you shall get your receipt. If the tax authority discovers or is of the opinion that the employer has not been remitting taxes, the tax authority may, within the year of assessment or within 6 years after the expiry of the year of assessment, assess the employer. So the tax authority is suspicious of the employer that this person has not been paying tax, or the tax authority can come to you and say, okay, you have not been paying tax, so we want to check your books of accounts. We want to assess you by ourselves. In that year of assessment, this can occur. And it can also occur within 6 months after the year of assessment. After only 6 months, within 6 years. After 6 years, it's called backdated audit, tax audit. Backdated tax audit. So it means that 6 years have passed, or don't let me use the word 6 years. A year has passed, 2 years have passed, and they now come and this is 2026. That authority can come to your shop and say that they want to audit you or assess you on 2023 profit or 2023 salary for your employees. You can be like, that since how many years? They are still within their rights. As long as it has not passed 6 years after that particular year, they can still backdate you. It's called backdated audit, tax audit. They will audit you. If they see that you've paid the correct amount, lucky for you. If they see that you've done mago, you will pay the money. You will pay the remaining money together with what? Penalty. I hope we are good. So now let's move to self-employed. Now we're no longer talking about payee now. We are talking about people that have trade or businesses. They earn profits and not what? Salary. How do we? Sometimes they might also earn salary, but they also shall have a particular business where they earn profits. So now these people, because they have trading business, There are some expenses that are allowable and expenses that are not allowable in their words, in their businesses. Now, let's talk about the expenses that are allowable. Are you guys still there?
Yes.
Thank you. The class have reduced from 19 to 30. Everybody it is salon. It's not my fault. You guys have to understand this thing before we move to calculation. And I'm not even sure if we can reach calculation today. But let's continue. Allowable deduction. Number one, interest on money borrowed and employed as capital in acquiring income. So you need to expand your business. Then you went to Jais Bank or I should not use Jais, First Bank or UBA to go and borrow money. Then you are expected to pay interest on that money. That interest is an allowable expenses. Interest on loan for developing owner occupied residential house, allowable. Owner occupied residential house, like the house that the owner, how can I say this like this? It's your owner occupied the house that you are living in, but you took out loan to build the house. It's this is a sole proprietorship in now. It's not a business that you'll be separating the two. Rent for that period and premium liability for which it was incurred in the period. Rent for the period is allowed. I don't understand this premium they put, sha. Repairs of premises, machinery employed in acquiring income, or repair, alteration of any utensils or articles, domestic or personal use is not allowed. Now, this repair of premises, um, you want to repair your place of work or the machine I used to, you're not supposed to put personal money there. Like you repair your personal car, it's not an allowable expense. Provision for bad or doubtful debts. If somebody is speaking, Wilfred, your hand is up.
Yes, just wanted to add something on the owner occupier resident.
Okay.
Yes, to what I know is that maybe like a company that provide accommodation for the staffs. So if you use the money from the business to develop such accommodation or such property, I think according to what they are saying is an allowable expense. It's not the
Oh,
personal own house that you have differently from the business because the house is also accommodating the employees who are working for the organization.
all right. Thank you for that clarification. I hope we all got it. Okay, thank you so much. I want to stop this class by 6:30 because I have to prepare to break my fast. So let's continue. We have 30 more minutes. So we have provision. Any provision for bad or doubtful debt of a specific, the word specific. So we have specific bad or doubtful debt provision. Any bad debt written up is also allowed. Contribution to pension, provident or retirement fund, as long as it is recognized under the Pension Reform Act. Legal expenses limited to general advisory service, retainership, renewal of shortlist. Any cost of protecting and defending the property of the business allowed. Any expenses that you can prove to the board that it is rarely incurred for the purpose of the what business is also what an allowable expenses. Now, disallowable expenses include domestic or private expenses, capital expenditure, any expenses or loss that you can recover under insurance contracts, which means that if your goods should get burnt or get stolen and you know that you have insured this good, that loss will not be an allowable expense because the insurance contract will what? They will reimburse you. Rent or of any promises that is not incurred for producing the what? Business income. Taxes or income levied in Nigeria or elsewhere, except for what? Dividend paid by a Nigerian company. That is franked investment income. Let me repeat it. Dividend is a franked investment income, and the only tax on dividend is withholding tax. Withholding tax is the final tax on dividend. Any payment to pension, Provident Savings Widow Society, um that is not recognized under this pension reform act. You know that we said it in this one, that if it is recognized, it is allowable. If it is not recognized, it is allowable. Depreciation disallowed. Any sum reserved out of profit, that is reserved profits or reserved earnings, is allowed, or retained earnings. Expenses incurred within or outside Nigeria for any management fees, unless prior approval has been given to what the minister. For any management fees, any expenses incurred outside Nigeria as within or outside Nigeria as management fees under any agreement entered into, except to the extent as the minister may allow. This too is quite confusing. I'm not really certain of what they are speaking about, Sha. Now we want to talk about the gross income of an individual. Remember that an individual may be a 9 to 5 person, a salary earner, and can also have a business, right? You can be a salary earner and you still have a business. So your salary, your employment is based on actual year basis. Remember that one will be subjected to pay you. It's pay as you earn. As you are earning in January, what your work in February, what before they remove your money before you are paid your January salary. So it's actual year basis. But when you talk about unearned income is preceding year basis. You know, unearned income is dividend, rent, royalty. Those ones is going to be what? PYB. Please put it in mind. Sorry. Please put it in mind that those ones are was PYB. Tax exempt deduction. Tax exempt deduction. Number one, these are deductions that are tax exempt, that is, they are allowable deduction. You are not supposed to calculate tax on this particular amount, so you deduct them before you calculate tax on your gross income. Number one is the National Housing Fund. Now, a Nigerian that earns 3,000 naira or above per month, whether you work in a private sector or a public sector, shall contribute 2.5% of his basic salary to this particular fund. Employers that fail to deduct this money is liable to penalty of 50,000, while self-employed people are liable to what, 5,000 naira or 1 year imprisonment, or both 5,000 naira and 1 year imprisonment. The employer will deduct this contribution from the employee monthly salary and remit it to the Federal Mortgage Bank of Nigeria within 1 month of making the deduction. The Act mandates the Federal Mortgage Bank to collect, manage, and administer the fund. Contribution made to the fund are tax deductible. Sorry, give me 1 or 2 minutes, guys. All right, I'm back. Wilfred, you have a question? Wilfred, your hand is up. Oh. Okay, I guess I was a mistake.
Sorry,
So I've talked about the housing fund. Now we have the health insurance scheme. It was set up for the purpose of health insurance, in which a titled person insured under the scheme and their dependents benefit good and cost-effective health service as set out in the Act. This Act provides that employer that has a minimum of 10 employees may, together with every person in his employment, pay contribution under the scheme. In the public sector, that is the federal sector, the employer is expected to pay 3.5, while the employee pays 1.75, which translates to 5% of the employer's consolidated salary, like everything together, right? Basic salary, housing, transport, everything together. In the case of private sector and other tiers of government, employer will pay 10%, employee will pay 5%, representing 15% of the employee's basic salary. Employer may decide to pay the entire contribution or even take extra contribution for additional cover to the benefits. And this contribution is what tax deductible. That's it about health insurance. Know that this tax exempt deduction, there are also ways of doing tax planning. That is, if you as a person, as an individual, you want to reduce your tax liability, just do these things. It will help you to reduce it, and it's beneficial now. Health insurance is very good. Life assurance premium. So if you have any premium that you are paying for life assurance, it's also tax exempt. Pension, same thing. So rate of pension is minimum of 8% of employees' monthly emolument. That is 8% of your basic salary plus housing plus transport allowance as contribution in both public and private sector. But 10% is what? The employer's contribution. It's only the employee contribution that you are concerned about, Sha. Contribution made by the employee is tax deductible. But the employer may do what? May agree to take all the burden. That is, can say that, oh, employee should not pay anything or pay everything, no. But his contribution should not be less than 20% of the monthly emolument of employees. So it is pertinent that this tax relief is only limited to pension contribution scheme, provident or retirement benefit funds that are recognized under the Pension Reform Act. Gratuity is a lump sum, like a payment given to an employee that is retiring or leaving his employer after several years of service, and it is tax deductible. Now, how do you calculate consolidated relief allowance? Remember that this Tax Reform Act has removed this CRA, but because your exam currently will be based on the previous rule, that's why we are still talking about CRA. Gross emolument. I have to take. Gross emolument means salaries, wages, allowance, including benefits in kind, gratuity, superannuation, and other income derived solely by reason of employment. Gross income now, please see the difference between gross emolument and gross income. Oh. Income from all sources. All sources now. So if you are an employee and you have business, your gross emolument will be from your employment. But when you're talking about gross income, your gross emolument plus your trading income plus your unearned income, everything, then you less non-taxable income. For example, dividend. Income on which no further, sorry, dividend is not non-taxable income. Oh. Income on which no further tax is payable, that's dividend. Tax exempt items, those are the items that we've listed: pension, life assurance, national housing fund, blah blah. All allowable business expenses, then you less capital allowance. What you have is now your gross income. So CRA is calculated on gross income. Sorry. CRA is calculated on gross income. Now let's check. No, we have checked the format before. I put it here because this one is more explicit. We have end income. This from your employment. It can be basic salary, gratuity, benefits in kind. Everything will be under end income, right? Then gratuity will be here. Income from trade or other source. This one has another format. It's similar to our normal company income for this format. Whatever you now get as a taxable income, you now bring it here. You bring it here. Then we have on end income. All your on end income will be at their gross amount. If you are giving net in the question, you have to change it to gross before you add it. Do you get? You have to change it to gross before you add it. Then you have add those two together to get your total income, less non-taxable income and GFI to get this particular result. After you have less your tax exempt item, that is your national housing fund, pension, insurance, gratuity too, if you have. You know that you have added gratuity here. Does not mean you not let it under tax exempt, you let it back. Then you have your what? Gross income. You have your gross income. Then you calculate your CRA, remove it, and you have your what? Chargeable income. It is on this chargeable income that you are not going to use your tax band. You apply your tax band to know your final tax. If you have any tax that you have paid before, maybe withholding tax or payee, you remove it to know your final tax liability. So now for the trading income that I said before, that it has its own format. This is it though. It's like company income tax. It's like company income tax. So you have the net profits, you add back the salable expenses or taxable income not reported, deduct what? Non-taxable income, allowable expenses not reported, then you have the adjusted or accessible profit. You relieve your loss. You add your balancing charge, your capital allowance adjusted, then you have your what? Income and trade from other source, which you go add to your what? End income in that other formula. Now, minimum tax for individuals now. Minimum tax for individual is 1% of his total income. 1% of his total income is minimum tax. So when will you pay minimum tax? When you have no taxable income because of large personal relief, or when your tax payable is lower than minimum tax. These are the two times or the two scenarios in which you are going to pay minimum tax. But minimum tax does not apply to persons that earn minimum wage or less than minimum wage. I think minimum wage now is 77K now. So if you are earning 77K or less, you're not expected to pay minimum tax. Filing of returns now. Employer and employee. For employers, employer shall file returns not later than 31st day of January every year. An employer is expected to file return with the relevant tax authority of all emoluments paid to employees in its employment in the preceding year. The return in respect of employees shall show the total emolument of each employee during the year, tax relief, total deducted, and you are going to the return will be in a specified format prescribed by the tax authority. So remember that you know that we have talked about the failure to pay, failure for remittance, that we talk about 10%. That is remittance. So this is filing of returns. Now, if the employer refuses to file returns, there's a penalty of 500,000 in case of an individual of corporate body. Corporate body, 50,000 in case of what? Individual. Corporate body means like a normal company. Individual, we're talking about the sole proprietorship, partnership, blah blah blah. For employees, every year, each taxable person must submit a tax return to the tax authority in the states where they are considered the residents. This return must show their income earned from every source. Now, we are talking about let's say a sole proprietorship person now, a partner. Like you might be an employer, but you have other source of income. Okay. We're talking about the ones that you as an employee, you are liable to by yourself. So now you have to show your returns that show all your income from every source, all the allowance and deduction that you have made. Now, this return must include a declaration saying that the information that you have provided is true and correct. So if you now submit an information to one tax authority, but you are resident to another tax authority, the information can be treated as if it was submitted to the correct person. If there is an error or offense, appropriate tax authority can take legal action as if the return was originally submitted to them. Let me explain this. You are a resident of Oyo, you went to go and submit to Lagos Tax Authority. So it is said that it is okay because it is going to be treated as if you submitted to Oyo. And that's according to them. Oh. But if you made an error or there's an offense that you committed, it is the original tax authority that you were supposed to submit to that will take up the error with you. Now, if you refuse to file your tax return and your only source of employment and their only source of income is employment. However, okay, sorry, a person does not need to file a tax return if your only source of income is employment and you earn less than 70K per month, that is minimum wage. Now, relevant tax authority. PIT covers individual, body of individuals, community of families, settlement, estate, and trust. Now, let's check about the tax authority is different from each, like, it depends on your own situation. They will know the tax authority that you are going to pay to. Individual, corporate body or so, corporate soul or body of individuals. The tax authority is the state where the individual is deemed to be resident for that year. So your tax will be paid to the SIRS of that particular place that you are resident. For other persons, for these people that we're about to mention, their tax authority is the FIRS or the NRS. Persons employed in Nigeria Army, that is Navy, Air Force, Police Force, other than in a civilian capacity. A resident person outside Nigeria that derives profits from Nigeria. Sorry, a non-resident that derive income from Nigeria will pay to FIRS. Every resident of FCT will pay to FCT IRS. Trustee of any settlement or trust or estate or executor of any estate, the relevant tax authority is the state that connects to your settlement, trust, or estate. Community, tax will be collected by what? The territory in which the community is found. For income of a family is recognized in Nigeria. Let me reach, please. So the relevant tax authority for family is the tax authority in which the member of the family that received the income resides. Like the person that used to collect the money on behalf of the family, where the person resides, the tax authority in that place will be the one to collect the tax on the money. It's a worker, we've talked about it before. Wherever you find the person, you tax the person, depending on the number of days. Offenses and penalties, this thing is very plenty. I'm sorry, we will not be talking about this. You have to live by yourself because it's plenty. You have to read it by yourself. It's very, very plenty. Then we can move to illustration. I don't know if we can quickly do one illustration or should we make it next class or would you quickly do one illustration now? Guys, what do you say? People have gone offline. Oh. Maybe we should make it next class and so that they not start asking me questions that where did you get this? How you talk about this?
Let's do it. Oh.
Should we call it a day here?
No, let's do illustration.
Okay, let's just do it.
Nobody's answering me. So I guess
Right, so that
we should do it.
We are saying we should do it. Oh. Let's do it.
Let's do it.
Okay, let's take example 1 then. It's not something that is hard. So I'm supposed to go up by 6:30, but let's quickly take an example. Okay. Mr. Yaya Ogunshowo, An employee of Cool Beauty Products Limited has the following salary package for the year ended December 31st, 2020. So we have the salary. They gave him 2 domestic servants and a night guard, and the company is paying for them like they're paying their salary. Then he collected a particular money. They reimbursed him for the traveling expenses that he incurred for official assignments. The company gave him a rented apartment. They gave him official car. This is the cost of the official car. Other information, he's married with two children. He has an aged mother that he gives this amount every year. He has life assurance premium. He pays life assurance premium. Rateable value of his residence is, see, we have rateable value. We have rateable value. Abi? And we also have the what? The actual rent paid. It's the rateable value that you will take. Oh, it does not concern the company that they are paying 450 when they feel like the house is supposed to cost 250. You get, so it's rateable value that you pick. So we have dividend received from a blue chip company. Which year of assessment is this? December 31st, 2020, which is 2020 year of assessment, like 2021, if you are doing PYB. Remember that for contract of employment, you use what? Actual year basis. So this is 2020 year of assessment. But for what? For dividends, for unearned income, you use PYB. And if you are using PYB, you only consider dividend of last year, which means we only consider 2019. We will not consider 2020. We consider 2019 because this is what 2020 year of assessment. So now let's start. What are you asked to do? Compute the tax payable for the relevant tax year. Now let's do, what's his name? Yeah, Mr. Let's do Mr. Yeah. Ogunsowo. Computation of tax payable. Sorry. So now we have end. Let me put end income up here. End income. The first thing that is there is what? Salary. Abi? Salary. How much is salary per annum? 6,500,000. See, this one will come here. So apart from salary, there's domestic servants, there's no bonus. I think salary is the only cash emolument that he has. So that's all for cash emolument. Then we have benefits in kind. Benefit in kind is BIK. Benefit in kind. So for benefit in kind, he enjoyed what? 2 domestic servants. Domestic servants. How much for the 2 of them? 400K. They say 200,000 for each person. Ah! Okay. Sorry for that distraction. So we have 2 domestic servants, which is 400,000. Then we have night guard. It's not supposed to be golden, you know. Night guard 150,000. Then this amount that was given to him to reimburse him for the expenses that he took. Actually, that amount is not a taxable amount. He spent money and the company gave him back the money that he spent. So you are not supposed to tax that money. It's not a taxable amount. Then he lived in a company house. Company house. And I told you that you will use rateable value. You use rateable value, which is what? How much? 250,000. Then what else? The official car. Official car. They give us the cost of the car. You will not write the cost of the car. 5%. 5% of the cost. Did we even talk about this? It's supposed to be in the material, but I feel like we did not talk
Yes,
about it.
we
Did we
talk
talk
about
about
it.
it?
We talk about it. Yes.
Thank you for confirming. So it's 5%, 0.05 multiplied by the cost of the car. In this question, they gave us the cost. If they don't give you the cost, they should give you the market value as at the time when they bought it. So if you can't find the cost, see the market value. 3,400,000. So you work. How many percent did I put there? 5%. No, no. 1, 2, 3. I wrote 34. I'm trying to put away here.
170,000.
All right, thank you. So what else? Do you have any other benefit in kind? No, I don't think so. That's all. So total for this one, total benefit in kind is this. Then we have what? Unearned income. Unearned income. So unearned income is going to be what? Dividend. Dividend. And remember, dividend is going to be what? PYB. Unearned income is based on, don't forget, please. And we have two dividends in 2019. We have 99,000, and we have what? Still dividend. We have 63,000. So total of the dividend of unearned income is this. That's the total of the unearned income. If we don't have trading income, we are not told that the man has a shop or something. So no trading income. No trading income. So we have what's it called? Should I say, I don't want to say non-taxable. No further tax. No further tax income. Something like that. Like income on which no further tax. No, before tax exempt. You have to remove dividend back because this dividend, no further tax is to be paid on it. Do you get? So it's going to be equals to minus. You are removing it back. So whatever we have here now becomes our, is it gross emolument? I think it's this one that is gross emolument. I don't leave space for gross emolument. Let me confirm. This one did not write gross emolument. Okay. I used to put gross emolument when I did CIT. Okay, so let's put total income before we write this for no further tax. So we have total income. Okay, let's go then. Then you less this one. Then you now do tax exempt. Now, out of all the components of tax exempt that we have, which one does this man has? Life assurance. So it's only life assurance that he has as tax exempt. Since it's only one that he have there, we are going to write this quote under this one. Minus, how much is the life assurance? 48,000. I think that's all. I don't think there's any other thing. So then we are going to calculate it together to get our gross income. To get gross income. This one is our what? Gross income. Then we calculate our CRA. Remember, to calculate CRA, let me put it down here. 200,000 or 1% of 7,422,123 plus 20% of 7,422,123. Please, I hope we get it. I intentionally wrote this thing out so that we'll not get confused if we are coming back to this work. So now let's check. 1%, 0.01 multiplied by 7,422,123, 74,220, which means that we are going to be choosing 200,000. Let me write it. The area of area to la. Oh yeah, come here. Area of So now because 200,000 is higher, we'll choose 200,000, right? Then one on there. 20%, 0.20 multiplied by 7,422,123 equals to 20% plus 200,000. So this one will be equal to minus 1,684,400. I guess our stuff has finished here. So that's CRA. Then we're now going to have our what? Taxable income, which is this particular amount. So on the taxable income, we'll calculate tax liability. To calculate tax liability now, we have first 300,000 at how many percent? At I think 7%. Next 300,000 at 11%. If I'm wrong, please let me know.
Well, 9%. 9%. Is not 9% before 11?
Do we have? I don't think we have 9. It's 19 that I think we have. But let me check. Let me confirm. This is the new one. The old one has 7, 11, 15, 19, 21, 24. So can you see it?
Yes,
at 15%. Next 500 at 19%. Next 1,600,000 at 21%. Then the remaining balance, these figures will be giving us 21,000. This one give us 33,000. I'm just popping it direct since 70,000, 95,000, 336,000. Now, let's go back to our calculator. The total of all of this figure is 3.2. 3,200,000. 5,737,600 minus 3,200,000. So now the remaining money, which is how much? Balance of 2,537,600 at what? 24 cents. So let's go back to our calculator, multiply by 0.24. Then we have 609,024. Total tax liability is going to be, this is your total tax liability. So that's it, total tax liability. So guys, any question? Before we call it a day, I really need to leave now. Any question? Samuel, kindly ask your question.
Hello, good evening, ma.
Good
Complete.
evening.
Sorry, ma. Please, what if we have dividend? If it's the gross value that is there, how are we going to do it?
If it's the net, I'll be gross.
Gross.
If it's net, I think is what you want to say.
No, if it's gross value, they give. They cannot give us question like gross value.
This one is net. That means we made a mistake. Oh. If they give you net, you convert to gross. Oh yeah, let's go back. Thank you for that question.
Okay.
This dividend is net. We convert to gross. How do you convert to gross? Let me put dividend workings here. Dividend workings. So, first dividend. First dividend. Because they say it is net, it means that this amount, they have already removed 10%. To get the gross, you are going to do the amount of dividend is how much? 99,000 divided by 90%. Mute your mic. Oh. Second dividend is equal to 63,000 divided by 90%. So to give you your 100%, please, can somebody call the figures for me? Let me calculate by myself. Nobody's calling figure for me. Stop it, Joe. 99,000 divided by 0.90. Sorry. 99,000 divided by 0.9. That's 110. So here is 110,000.
The other one is 70,000.
70,000. Thank you. So that's what we'll come and write here. 110, 70. Okay. So, but it will affect our tax, so because no, we did not. Let me just equals to this one minus 3.2. Let's close the bracket. Multiply by 24%. Okay. Did the figures change? I don't think the figure changed. Though. Just to satisfy myself. Though it's supposed to automatically change. Sha. Okay, I guess this is correct. So If you are giving gross, you use gross directly. In our question, we were giving net. You convert to gross before you use it. Do you get? Please, do we understand?
Yes, ma'am.
Any other question? So assignment, really assignments. I know that usually I don't have time to check people's assignments, but this one I'm willing to check, Sha, because PIT is quite important, like VAT too. So if you do your really assignment, come to my DM and submit it. Don't submit it on the group. I will not check. I will not like to. I already check group chat. Submit it to my DM, and I'll prefer if you snap it. Just snap it and send it. Okay. So guys, I see you next week Friday. I hope we're able to finish PIT and move to another aspect of PIT by next week. Guys, this is where we say bye bye. Video.